Excited to have Mr. Ty Kern with us on Rethink Real Estate today. Ty is an absolute expert in the lending industry in North America. Ty shares with us at the beginning of this episode a little bit about a story of the vast array of different things that he's done in the lending industry, now ending up running Cherry Creek Mortgage, a department of Guild Mortgage, which is one of the largest mortgage companies in all of North America. But that said is that it's going through an incredibly challenging time at the moment in the current interest rate market. We speak about interest rates, we speak about foreclosures, we speak about the adaptation of technology, we speak about what's going to happen in the marketplace. As vague as that question is to ask a guest, he definitely does a good job of sort of giving us an understanding of the current environment, what it goes to, but also the innovation that comes into any marketplace when it's difficult, or any industry when it's difficult, is sort of some of the things he gives us some light on as well. If you're a real estate professional and making sure that you're thinking laterally about different things that could affect the real estate space, this is certainly one of those episodes. We hope you enjoy. Welcome to Rethink Real Estate. My name is Ben Brady, and this is a real estate podcast aimed to deliver sales strategies, marketing tips, and business insights from industry experts and myself to build a listing-focused business for the future. Let's get into it. Well, Ty, it is a complete pleasure having you on Rethink Real Estate. How are you, mate?
I'm doing great, man. Ben, great to spend some time with you. Always good to spend time with you.
Well, this is an episode, as I was explaining before we jumped on, is that I think that I'll get just as much out of it as any of the audience because, you know, you and I have the benefit of communicating regularly in perspective to what the market's doing, and the insights that you can give us into the lending industry and then the parallels in the real estate space, I think are very powerful for our audience, certainly from a North America perspective. But there also is an international part of this that I'm excited about as well, Ty, because it seems to me that everywhere else in the other countries where we have people that listen in, their marketplaces are behind the US market. So it might give them some insights to what might be coming.
Sure.
So,
first of all, thanks for having me on. And if I can help anyone in any way, as you know, that's a big thing for me. So I'm happy to spend the time, and hopefully, if people tune in, they get something out of it for their investment.
Well, I guess that I'm going to say this on your behalf, is that you're kind of a big deal when it comes to the lending industry in my eyes from what you've done. But I'm gonna let you put it into a little quick synopsis of where it started for you and how you got into the space and where you are now in that journey.
Yeah, well, listen, I appreciate that, and you're giving me way too much credit, brother. And I'll try and give you the Reader's Digest version of the last 30 years because that's how long I've been doing this. I started out my life definitely wanting to be entrepreneurial in some way. I knew I was either going to own my own business or wanted to own my own business, or didn't realize at the time, commission sales is, pretty much the same thing. But when I started my work life, I had gotten a scholarship to play football at a university here locally, and I decided not to take it. And I decided to start a business with a friend who still runs that business today, by the way, which is amazing. And we, it started with carpet cleaning and sort of odd jobs, ended up being light bathroom and kitchen remodels, and then now it's a full-on construction company. But I realized towards the end of my college year, 4 years of doing it, it's going to be really hard for both of us to earn the kind of living we wanted. And I was a finance major, and I was, I was sitting with another friend in class, and he was telling me that his older brother was a loan officer. And I said, well, really, how's he doing? He said, well, great. He said he's making a ton of money. And I went, really? I knew his brother. Let's just say not the sharpest tool in the shed for sure. But I'm like, well, if he's doing that in commission sales in the lending business, I like numbers. I like sales. I was basically the salesman for the construction company. I was the one that knocked on the doors and tried to get us jobs, and my partner was more of a tradesman or craftsman, and actually did the work. I never understood what he was saying. I just knew we could do it. So at the end of the day, I jumped into the lending business, and I started in retail. Didn't make a penny for 6-7 months. Ended up having a relatively good last half of that year, but really questioned my decisions. Ran up my credit cards, all the typical things you do when you start a business, and or go 100% commission sales. Thankfully, sort of recovered that year, and then I was sort of off to the races. I really love the retail side of things, but at that time, this is 92, 93 era, the mortgage broker started to come of age in that time, and wholesale began to be a more corporate job, and it was kind of considered a promotion at a bank to move from a retail sales position into a wholesale position. You generally got more geography, you could help more people, that kind of stuff. Had an opportunity with a company that was a great company to work for, First Nationwide Mortgage, which was owned by Ford Motor Company. Had a great run there with a group of friends of mine that are still close friends of mine. We all knew each other in college. We sort of all flocked to the same business. We all sort of traded positions on really second, third, fourth, or fifth out of in the country, because there was one of my friends was just locked in at number one. We could never unseat him. I was pretty happy though when I did make a move to enter First, which ended up being the largest wholesaler of its era, sort of the UWM of the 2000s. I was able to, once they opened that governor and we started using more technology, I was able to scale a little better than he was and grew some businesses to be 2, 3, 4, 2, 3 billion a year as a rep with no assistance, no anything. I was quickly told, though, after I'd done that a few times by the CEO, we're not going to continue to continue to cut commissions and pay wholesale reps that kind of money. So you're going to lead, my friend. You're going to teach people how to scale and teach people to do what you do. And I was a little unnerved by that at first. And then when I really realized that all I was doing as an account rep was serving other people's needs, getting what other people needed done. They happen to be my clients or referral partners of my clients. And then as a leader, all I was doing was serving those people and teaching them how to serve others. And quickly realized was able to run some pretty big businesses on the wholesale side, 8 to 12 billion a year. Really enjoyed that. 2008 hit. Obviously, we all know what happened there. Citi Mortgage had bought us. And unfortunately, we ended up laying off the entire wholesale division, had a very small correspondent piece left. I then sort of just consulted a bit on both the finance side and then in the pharmaceutical business, a little CFO to project to build some single unit dose packaging things just to try to get my mind off the market. And, right at the end of 2009 or so, I started looking back at the mortgage business and ended up doing some more consulting. A good friend of mine, who was a very large wholesale account of mine, ended up being one of the largest dollar volume brokers left in the United States. I wrote a business plan. He said, great, let's do it. You're hired. I said, wait a minute. I thought I was consulting. And next thing I know, we were entering a phase of, taking that wholesale broker platform into the mortgage banking space. Fast forward now through retail, we've been lucky enough and blessed enough to be able to, and fortunate enough to be able to build, say from zero to, 3.5, 4 billion, 3 times on 3 different platforms. We're now on a platform with a Cherry Creek Mortgage division of Guild. And let's say it's hooked at the 4 times the charm, and we can hang out here and go to 4 billion and beyond. That's about I can do that 30 years, buddy.
That's a really great synopsis into the fact that there's just some deep intricacies that you have in the industry, not only on the retail perspective, but then the wholesaling perspective as well. What would you say to somebody that is like they're sitting back and let's say that they're incredibly naive to the financial industry? They just know that a bank gives somebody a mortgage and that's how they buy a home. What would you say if you were going to give a quick 30-second overview of sort of the lending industry from the perspective of then you've got the banks and then you've got wholesaling and then you've got lending? How would you say that is all tiered for somebody trying to wrap their head around that?
So the actual structure of the industry, the way it works?
Yeah.
Okay, so you have there's several channels of lending, right? Distributed retail is actually loan officers working for financial institutions in the community, right? There's brokers that also are in the community lending and they're getting their financing from other banks. There's consumer direct, which is an online relationship, not necessarily in the community, but trying to be sometimes in the community or not.
Is that like Rocket Mortgage or something like that?
It'd be Rocket or Bank Rate, something like that. And then, then there's correspondent lending where you're actually buying closed loans, whole loan purchases, right?
Okay.
In a nutshell, that's that. And then, of course, there's the servicing side. I guess who you choose or what mode you choose, what channel you choose depends on your circumstances. When I look at the competitive landscape, I would say that you've got your commercial bank retail LOs competing in market, for the community business with your independent mortgage banking distributed retail LOs. And then they're ultimately competing with their counterparts on the broker wholesale side that are considered more, I would say, self-employed.
Okay, understood. So what do you think has been the biggest change, Ty, over your duration between 2008 and everything that happened there? What were the biggest regulations that came into the lending industry post that fiasco, for lack of better terminology?
Oh man, there's so many, and most of them are designed to protect consumers. And unfortunately, I don't think we did a very good job of that as an industry. I will tell you, I think the real estate, I think NAR and the National Real Estate coalitions that are made up of real estate agents and brokers do a much better job of protecting their industry than we do, and that's on me too. I should be more involved. All of us should be more involved on the lending side, and we're not. I will tell you the regulation to me that just still makes zero sense, and I think it causes it. It's one of those things that if you don't know what it is, it sounds like it's really good for the consumer and for business, and it's horrible. And that's the broker LO comp rules.
What are they? Say that again to me.
It's the broker LO comp rule through Dodd-Frank.
Okay.
It basically fixed a commission regardless of what happens for any loan officer or broker that when they sell a loan. So they can't make any more or less money than what that commission is the design, which was designed to protect consumers. And I fully understand that. But if we're being honest as an industry and we take a look at that rule, if you take a look at what loan officers made on the wholesale side and on the distributed retail side prior to that law going into effect, which was April 2011, I'll never forget it because it's changed the way we do everything. Since before that mark, if you were looking at loan officers, just say from 1993 to 2011, what their average income per loan was, and you take a look at that mark post 2011, loan officers make twice as much commission as they did prior to.
Is that just because of size of loan, or is that?
No, it's because you're fixing in a commission to be a certain basis point number rather than choosing an interest rate and a set of circumstances for a client. It was designed to keep people from overcharging, but what happened was the marketplace, when you're competing against banks and brokers are competing against people in distributed retail, sheer competition drove commissions down.
Yep.
And now that competition really doesn't exist.
Right. So people are just trying to max out them trying to max out the amount every single time just through a certain way. Is that right?
It's not even a max. It's a rule. It's an actual rule, and independent mortgage bankers and certainly commercial banks have to live by that rule of what's on the contract. It's good for loan officers in the sense they can count on what they make exactly in each transaction. But there's all kinds of things that happen in transactions, and sometimes money gets lost and things. And it used to be a partnership to get that customer in. And I think the rule was really designed to hurt brokers because brokers had 70% share going into 2008.
Right.
Is several wholesalers have you choose different comp plans for each wholesalers, and the comp plan is only designed if you send a loan to that company. So
right.
A broker LO has much more opportunity to make a certain number of basis points if I go to lender XYZ, and a different basis point number if I go to lender ABC, and so on and so on. So the rule didn't do what it was designed to do, and I think it's hurt the consumer in the long run, and I think it's hurt the loan officer in the long run from being able to compete and do what they need to do to get a transaction in the door. And
it's interesting.
And it's hurt the institutions because if you play by those rules, to the letter of law, like we have to and should do, it takes the competition out of it.
It feels like there's just so many more intricacies in the industry of the loan business than what there is in the real estate industry. And again, I might be being naive to that, but it feels a great deal more complex. It feels a great deal more competitive. It feels like it is a dog eat dog world in the financial world. Do you think that's an accurate assessment?
Well, in a market like we're in right now, I don't think it's ever happened in history where we've gone, at least in this business, in our business, from the absolute best market ever to the absolute slowest and worst market ever.
Right.
From a lending perspective, I think when we look at the numbers and how long this lasts, ends up it's still going on. This bear market in our business goes on. I think that the 2022, 2023 downturn in our business is going to be the worst in history.
Right.
It just dropped off a cliff.
And that's based on volume. It's not. It's just based purely off volume of loans written. Correct.
100%.
So this is something that I just want to understand a little bit more, because I often think this is the case. Leading into 2008, 2009, was it like put it this way, going back to Australia and New Zealand and a lot of the other countries around the world and understanding their marketplaces at the moment, I think that inventory is starving both the loan industry and also it's starving the real estate marketplace. It's honestly just putting a stranglehold on it. It's unbelievable. I've never seen anything like this anywhere. And the thing that I just don't understand in North America, trust me, I love it as a consumer that's not in the loan industry, but I hate it as a realtor, and I hate it as if I was in the financial world, is this 30-year fixed concept. In Australia and New Zealand, it resets. The longest that you can set a loan up is maybe 5 years, but it typically is resetting every 3 years from the rate perspective. So therefore, the inventory and the homes coming on the market based on not being able to afford that property anymore is important. They obviously do stress tests when people obviously apply for loans and things along those lines. But I can't see this coming to an end from an inventory shortage perspective anytime soon, because of people like me and Callista, my better half, being locked in at 3% on our mortgage for the next 30 years.
Oh, there's no doubt. I mean, our biggest problem right now, I would say 2022, the biggest problem was volatility. I mean, of course, we had inventory issues too, but I mean, my gosh, in a typical day, we had rate swings of several hundred basis points and 4 different prices to sell. I mean, like if we were selling sneakers and at 8 a.m, the sneakers cost $50, and at noon they cost $100, and at 4 o'clock they cost $125, right?
Yeah.
How do you sell the darn thing? So that was the biggest. I think volatility is what killed us in 22, even more than the inventory. And now that it's been more stabilized and we understand what we're sort of skating to, it's definitely inventory. And that means different things to different people in different parts of this country too, from a regional perspective. There are places that were planning for massive growth. Builders were doing what they needed to do. And sort of the migration, I think, from a lot of major cities into more, southeast or rural areas. I think, some of those areas are thriving, but you're right. Inventory is a serious thing. And who the heck wants to give up their 3% interest rate to go buy or move up, right? They're much more likely, I think, now to take out some money and build on what they have with a second mortgage, or, do something different than, absolutely get rid of that house, or keep this house and rent it out and get a new one. I think
so you've literally just mirrored the conversation that Callista and I have had about our situation, in the sense that it's like, well, if we want to buy something else or we want to do something else, why would we ever sell our place, considering that essentially is free money, because we don't believe rates will ever come down to that low again. Do you think that's a fair statement?
I mean, if I could predict the markets, brother, I'd be having this from my private island somewhere. I certainly, it's hard to imagine rates going back under 3% in my lifetime. I can't see that, but who knows what 30, 40 years holds. I think the market could get interesting if we at least could put a 5 in front of our interest rate, get back into the high 5s and high 4s, trade in that range. I think that would be would boost. But you're right. If there's not enough homes, if there's, in a certain market, if there's 5 buyers for every house, we're still going to have an inventory problem, and that supply problem is still going to keep houses moving up too, right? So it's not just interest rates. We've got a supply and demand issue, not enough supply. And that's all going to lead to an increase in value.
Has it always been the case in North America that you can lock a loan in for 30 years? Has that always been the case or not?
In my lifetime, certainly it has. I should probably be a better student of the game. I can tell you, since 1992, when I got into business to now, that's definitely been the case. I will tell you, though, I remember my parents buying a house when I was in my teens in the 70s. I just dated myself, didn't I? But when I was just going into my teens in that like middle 70s era, when we had some pretty tough economic times, no one purchased a 30-year fix back then that I'm aware of. They were at 14, 15, 16%. So, and I remember my parents' first mortgage was a 9% 1-year ARM with a 6% cap on it, a 2% cap per year and 6% over the life. And everyone did those ARMs. There used to be something called 11th District Cost of Funds, which is a slower moving index, which is a lending rate between these banks and these districts. And everybody was on an ARM loan back then because no one could afford 30 years at 16%.
Yeah.
And so I guess that's a long way of saying, or a long-winded way of saying, if rates go up enough and stay high enough, then that will be a situation where ARMs will dominate. But in the last 30 years since I've been in this business, I would say that fixed rates have dominated the market since I've been in this business. There are times where we sold more ARMs, certainly. Middle 90s or so, we were selling quite a bit of the 5, 7, 10. And when rates creep up into that, where we are now, 6, 7%, I think you start to see more ARMs, but it's still a very small percentage. And I think consumers and people, families that have owned homes, have had home ownership in the States here, I think in general, it's considered safer, more stable. People want 30-year fixed interest rates or 15-year fixed interest rates if you can afford them, certainly. But
so it kind of leads me.
It's definitely a consumer mindset to go.
Yeah.
It's dominated the market for the whole 30 years I've been at it.
Kind of leads me to another question, Ty, is that you see different innovations at different times based on the different situations that arise within a marketplace. So where I'm going with this is that, obviously there was a situation that led to the subprime issue, was the subprime product, right? That was ultimately there in order to spur the market on from the .com bust, maybe, I don't know. Again, I'm making complete assumptions here. What can you see anything coming down the pipe that institutions are doing at the moment to provoke more business? Because there's always that innovation. I shouldn't call it innovation because sometimes it is an innovation. Sometimes it's just deal making. Can you see anything like that coming down the pipe that more institutions are doing to get people to do stuff now? It's like, is it lower rates for a period of time for the first year, like those ARMs that you're talking about? Is there more coming down the pipe?
Yeah. So I think I think 2004-ish, going to 2005, interest rates had risen to a level, and I think Wall Street and banks that had money to lend and had capital to lend did not want that 02, 03 party to end. So 2004, 2005 hits, and you have no income, no asset deals. You have all these things. Hey, look, credit score is everything. Home prices are going to go up forever. Let's keep this party. Let's stoke the fire, right? I think the products that we need now, and what you're asking is, what's going to come on the pike now? It's really to get the party started because no one's going to move, right? We need something. We need some kindling to get this fire to start in the first place. We just announced a product I think is fantastic, which is a second trust deed that it's not out yet, but it's supposed to come out in the next few months. And it's a second trust deed that does not have a payment. It's an equity share. So you can take out up to $300,000. And this is not I don't want to get this into a guideline question. I'm sort of paraphrasing here, but for argument's sake, you can take up to $300,000 out of your home, whatever percentage that is of your equity at that time. When you sell the house or whatever term you choose, we share in that equity and there's no payment because seconds are pretty highly rated now. Now that enables somebody like you who's sitting on a lot of equity, likely with your 3% rate, to do something with that money, invest in something else, send your kid to college, pay for a wedding, pay off something else. It gives you some chances to tap into that and use your equity to do it, and not because you're an entrepreneur like I am and like we all are, not hurt your monthly capital expenditure by taking something out that is too expensive.
I was just about to say that because, we have a line of credit on our property that we got when we first started. It was kind of baked into our mortgage.
Mm-hmm.
And essentially because that was just the way they said, hey, save you having to apply for it later or whatever it is. And it was based off a pretty modest valuation. Now that the property prices have just skyrocketed in that area, you and I live in the same marketplace, is that they've just gone crazy because of the lack of inventory. I'm like, now's a great time to get another line of credit. But realistically, I'll probably never use it because it financially burdens me if I pull any money out of it every month, that I'm having to pay a monthly amount ultimately because of the interest rate. And I don't really want that. Like, it's kind of dead equity.
Yeah, and most of those are floating rates, so you're paying
10%.
Yeah, you're going to be paying some serious money at this time. I applaud our capital markets department for coming out with something that doesn't have a payment and an equity share. Super safe way to do it. Still gives you some nimbleness. I think if you're certain ages, I think reverse mortgages can be awesome for the right people with the right equity, and there's can be no payment associated with that as well. The rest of it is, if you're really taking a look at where the market's going, as inventory does open up, as builders build more, as resales do come back on the market, and it will happen. And I think our rates do need to get in the fives, to help spur people qualifying. It's going to be a massive amount of first-time home buyers. I think the agencies have really are getting back to the original sort of charter and the purpose of the charter, which was to foster home ownership in the United States. So we have the highest home ownership rates in the world, and I think it's generally worked for our country, and it's been a huge thing. And between VA, FHA, Fannie and Freddie deals, we just need to make sure that we're serving our community in a way to where those millennial home buyers can get in, their Gen Z buyers can start to get in. I think that's really where the opportunity is going to be the next 3 to 5 years. And I don't even think there's anybody disputing that at this point.
Yeah.
And that's going to be hotter in depending on, where you are regionally, right?
No question.
California is a much more mature market with, a lot higher values. And I would say that in most parts of California, certainly in and around the cities in both Northern and Southern California, being a first-time home buyer is pretty darn tough without help. Right? But you can get in other parts of the country, in the Midwest, Northeast, and Southeast, and there's still some very, very attractive price points. And if we can have the right products to help those first-time home buyers out, I think we'll have very good years in 24, 25, potentially even 26.
Have you seen the you've obviously seen the institutional buyer sort of pull back from the market, and I mean like the iBuyer programs. You've seen Open Door take a complete bath. You've seen all of those different sort of institutional people that have sort of pulled back from that iBuyer program. But then you're seeing a great deal more institutional buyers going in and buying up property in order to then cash flow and all that type of stuff. Have you got any insights to any of that at this point through the big lending platforms that you're a part of, Ty, and the word in the industry of whether that's an appetite that's going to continue or not?
It's hard to say. If you would have asked me that question in 2020 or 2021, I would say that was going to be an absolute force. I think the one thing a tough market like 22 and 23 will absolutely chase that type of investment away. I think there's a place for it in the market if the inventory is right and the circumstances are right to do it, but it can be massively expensive if you miscalculate that.
Right.
And many of the iBuyer programs, really, they were good at something else, and they thought, hey, the real estate part's just as easy. Let's jump in there. And I think they learned pretty quickly that can be a very, very expensive proposition if it's not done in the right environment.
Yeah, for sure.
You and I work in very cyclical businesses, my friend, and they're codependent on not only we're codependent on each other, but we're codependent on a bunch of market conditions as well. And it absolutely varies hugely market to market. It's very different doing business in Franklin, Tennessee today than it is in Newport Beach, California. I mean,
That's fair.
it would be hard to draw even almost a parallel between those two markets, right?
Yeah.
It's much different in Scottsdale than it is in St. Louis. And we're seeing those regional differences in marketplaces really come to play. And, that's why we really promote, as you know, with Aaron and others, enterprise level business, I think is super, super important right now to have, to add value to your community at an enterprise level and really help loan officers and real estate agents help get their next deal or two, because I think everybody needs help. And as you know, definitely. On success is helping others goes along with it.
So leading into this, I obviously have wanted to ask you what is going to happen. Like it's a shit question, I'll be honest.
Yeah.
Okay, and it's one of which that is so vague that I ask a lot of people in different industries. I asked a commercial gentleman the other week that is one of the head office guys for CBRE in Southern California. I asked him what's going to happen. He's like, "Oh my God, really?" Because my answer has increasingly become I have no idea, and I'm okay with that answer, but realistically, what's going to happen to rates here, Ty? Like, do we see, like, you obviously haven't packed up shop and you haven't changed industries, so you can see light at the end of the tunnel. I haven't packed up shop from real estate because I might be able to see some light at the end of the tunnel, but I have a skill set that's only for real estate, so I'm limited. What are we looking at here? Because I listened to another podcast called the All In Podcast. There's some very successful people with some ties into the technology world and ties into a great deal of different marketplaces from a financial perspective. And they said this is going to last way longer than all of us want.
I can tell you right now, just it's already lasted longer than any of us wanted. And believe me, I have no idea either. I'll take a wing and a prayer here and give you sort of where I think things are going to land. But
give the listeners what they want, Ty.
Yeah, but by no means. Look, I'm an eternal optimist. I mean, I don't know how you can be in our business for as long as we have been in it. And I know, you're super young, but this is what you've done your whole life. So you've got a remarkable amount of experience for somebody at your age. I don't think you can be successful without being optimistic. You know what I mean? I just don't think. I think that's got to be something. Of course, then you need to have a great attitude and a hard work ethic. You got to be a grinder. And I know that about you, and I think you know that about me. So
yeah,
I think that most bad markets don't go beyond 18 months, and we're already beyond it.
Right.
Okay. And I think, like you said, and like your guest said, I think this is going to go on, perhaps another 3 or 6 months, which will make this one of the most bearish markets from an interest rate perspective in history. Maybe it even goes on 9 months. I mean, 6 months is going to feel like walking over broken glass. I can tell you that right now. And we've been walking on it. Now they lit a fire under it, and it's going to be difficult. But I do see us coming out of this, and I think it's going to be a matter of alignment with the right, in my case, the right company and firm. And I think I'm fully aligned where I need to be and where people need to be with products being paramount and capital structure and liquidity being paramount, and technology forward, all the things that we think we're going to be there. And we can't control. I always use this analogy, sort of farming. I can't control if it's going to be sunny for 6 months in a row or rainy for 6 months in a row, or I'm going to get optimal conditions. But I can control plowing every single day. So when those optimal conditions do hit, I will yield the crop.
Yep.
Right. That's the only thing that I can do. And I can tell you all we'll do. And I preached for years, don't ever confuse, in my coaching sessions with the teams that I work with, don't ever confuse activity for results. And for 28 and a half years, that has been a great coaching call.
Yeah.
For the last year and a half, all we can control is activity. I mean, if I've got somebody, if we've got people working their markets as hard as they can work them, and there's 100 buyers for every home that's for sale, all we can do is do what we can do there, right? So there's got to be some forces in the market to help. I really do believe that sometime between the next 6-9 weeks and 6-9 months, we will have an interest rate environment that will get us into at least the high fives, middle fives, and it will spur activity that's probably 2 or 3 times what the activity we're experiencing now. That will be, if we can get into the middle fives, that'll give us enough interest rate change to at least have a small refinance market with all the loans that we've done in 22 and 23, right? And then you've got some chances to spur some get payments down to a level and affordability down to a level that it helps that first time home buyer. But we're still, what's going to happen, what actually happens with the actual inventory issue, I think remains to be seen.
Yeah.
And I think it's going to be regional. I mean, if you're a builder, and you're building somewhere in the Southeast, Florida, Tennessee, Texas, or in the West, Arizona, where people are moving, I think you're going to have you can have a boondoggle in 24 and 25.
Yeah.
But I think it's going to be tight in markets that are more mature.
So, Ty, final part of this sort of podcast that I wanted to leave on is that you've got your fingers connected into so many different businesses and so many different products and so many different elements of the lending space. Technology has really infiltrated the space over since you started to now. You, I think, have been really great at adapting to certain technologies in your business in order to create efficiencies while still making sure that there's still a personal connection, because it's one of the most personal transactions you're going to deal with somebody on, even more so than the real estate side, because somebody has to lay their shit bare to you in order to get what they need. Mm-hmm. What is changing in the industry? I still don't believe in Rocket Mortgage. I still don't believe somebody will completely apply online with all of that stuff. But am I naive? Am I wrong? I don't understand how it can go from your bank manager going and seeing them back in the day to get a loan all the way to literally just plugging your stuff into an app. You can't even do it online on a desktop. You've got to do it on an app on your phone. So there is a polar difference in where that's gone to. There's obviously a middle ground in all of that. What is your view from a technology space? What do you think is happening? In the real estate industry, you've got cannibalization of commission splits and signing bonuses now that have gone away. And because of the market driven, there's been this whole venture capital publicly traded space that has happened that hasn't worked out because no one's profitable. That's really harmed the industry from a long-term perspective, I believe. Is there something happening in the lending environment that we as outsiders should be cognizant of? And from a technology perspective, what's changing?
Well, I just think as an industry, we have been horrible at adapting to technology and making technology a real thing. I can tell you back, in the early 90s when I started this, they were talking about, hey, man, when you go to your bank and you pull cash out of your ATM, they're just going to offer you a $500,000 loan for your next home purchase. And that never happened, right? And part of that is just when you're talking about collateral, title, credit, assets. I mean, if you think about, really, we're financial doctors. When we have to get with somebody, we're going to give them a financial colonoscopy to really understand it. We're going to understand, everything about their credit history, everything about their asset history, everything about their income history. We're going to understand everything about the property and the chain of title and all those things. There's a lot involved there. And that hasn't changed. I mean, what's changed in the lending industry is we've gotten really good at sort of sourcing customers and interacting with them in a more pleasing way and customer service friendly way. Point of sale has gotten a lot better, but how we manufacture loans hasn't changed a lot. Now, I think that's going to change with AI. And okay. I, for one, to get back to, is Rocket going to be successful? But I could argue right now that Rocket already is successful what they're doing. Now, whether they actually deliver on the advertising message they give, I can't answer that really, but I can tell you, obviously, they do a lot of volume. They're, I think, the largest mortgage lender in America, so that it's worked. The advertising has worked. I do think AI is going to change things dramatically in the sense that the way we manufacture a mortgage, check guidelines, those kinds of things, the inner workings of getting all that documentation together, getting it read, getting it compared, understanding it, has been a big value proposition for a lot of companies, a lot of loan officers. And I do think, to your point and to everybody listening, AI, you can't AI relationships. So at the end of the day, I've always been preaching, and I always think if you're out there to help people in your community, try to understand the home buying and selling process or refinancing process in whatever case that may be. And you're there to help people in your community, achieve the American dream. And you're making the right relationships on a B2B perspective with your real estate partners or builders, and you're being exposed to buyers and sellers, and you get the part of helping people get there and their knowledge get there. I think AI will take over the clunkiness of the financial colonoscopy, excuse me. And I think that's great for people that thrive on building relationships and helping people.
Yeah.
It's going to be a true sales job. And I would give the edge to somebody inside a community over somebody on a phone any day of the week, as long as we can achieve some sort of price parity there. And I think the manufacturing of the loan through AI will achieve that parity.
That's a really, do you know what? Coming into this, I hadn't even thought about AI for some reason, but it's obviously something that is definitely in a process-driven world, like the loan side of things, like escrow, like title. I think it can have a gigantic impact in the processing of all of that. But that whole overarching relationship side of things, I don't think gets affected by it outside of the efficiency that it then creates.
The great news for salespeople in our industry, whether it be on the real estate side or on the loan side, is, my gosh, if you're a relationship creator, if you're out there trying to add value to other people's lives in the most dynamic way you can, and the biggest investments that they're going to make in their lives, you're going to be in a great spot. But if you're going to, sort of put your die on the cross of, I'm a loan manufacturer, right? I think that's going to be less and less what salespeople do. Think about it. We work in the only industries where the salesperson actually has to manufacture the actual transaction. If you buy a car or a desk, the guy that sold it to you didn't put it together, right?
That's so good point.
but we do that in my industry, and in some cases yours as well. And I think at the end of the day, as that goes away and this goes down to, okay, who can help the most people in the most dynamic way and create the most relationships wins, I like somebody in community for that.
Yeah, that's good.
In a community that's where their kids go to school, that's where they eat, work, live. I think that becomes a huge value proposition.
The final thing that I want to ask you, and I know I said that the last one was the final thing, but I think my audience would lynch me if I didn't ask you. Ty, you and I are business partners in a business that is focused on distressed real estate when ultimately it does become a thing again. And I foreclosures, REOs, all of that stuff is that we've been hearing this shit from people for so long, saying it's coming, it's coming, it's coming. I think it's been 3 years now. It's coming, it's coming, it's coming. We haven't seen it. What's going on in the foreclosure distressed real estate marketplace?
Yeah, obviously that's not my expertise. You and I talk to a myriad of people that are experts in that, and they've been predicting that now for, I would say, probably middle of 21, right? And no one's really seen it. I think part of that is there's such a massive amount of mortgages that are down in that 3% range or even high twos, that people are tooth and nail making sure that they don't lose that thing. And there's been a massive amount of equity created. So there's hardly anybody that in these giant servicing books that don't have a lot of equity to try and make sure they make that thing happen, right? I have seen and talked to some people on the non-QM side of things where they are seeing some activity pick up there, and that's largely not full documentation loans. Those are largely self-employed people, entrepreneurs like us that are moving and shaking and doing things, and we are seeing some activity there. But when is that? actual, avalanche, something even close to, what went on in sort of the 08, 09 era happening. It's really hard to say. But I have been making lots of phone calls recently, and you and I will get on some calls. And I think there's a gentleman you should have on your call at some point on your podcast that could speak directly to that. And we'll talk about it after the call. But he has his pulse on that. That's been his major part of his business as a real estate person for the last 20 years.
Yeah,
got some definite opinions about it. It's it's like everything else. It seems as though we are in a holding pattern, period. And until that pattern breaks, we're all going to be sort of, the tail on the dog here.
Yeah. It's a loaded question. We don't know it. It's something that's out there. But is there, again, I think Andrew's who you're talking about, and maybe we'll have a conversation with him on the podcast, but realistically is there a big default rate out there at the moment?
No, I don't believe that there is. At least if it is, it's not being reported. I think people are trying to work out. Unlike the 08 era, everyone was upside down, so they were happy to walk away.
Yeah, exactly right. Where here, it's not the case. Yeah.
I mean, there's a mass amount of equity in homes if you bought, even if you just bought in 2020 or 2021.
100%.
You're in a good spot, right? So I don't think there is, but I think there are opportunities in that space that can be taken advantage of, and you just have to be super strategic. And it's going to be a scalpel, not a axe.
There you go. Well, Ty, thank you so much for your insights into this. I think that it's invaluable insights that agents should be in the real estate space thinking laterally about the things that is happening in the lending industry, because often the things that happen in the lending industry then fuel what the real estate marketplace is ultimately like. So again, thank you for your insights and joining us on Rethink Real Estate.
Ben, it was my pleasure. Thank you for having me. Feels really fortunate to be with you in this. I can't wait to talk to you again sometime soon.
Thanks, mate. So about 75% of our audience hasn't liked, followed, or subscribed to our podcast. It would mean the world to us, and it would help this podcast more than you know to expand our reach if you were to like, follow, or subscribe on any of the platforms that you're watching or listening on. Thanks again.